Welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Adam Mead. Adam is the CEO and Chief Investment Officer of Mead Capital Management and founder of WatchListInvesting.com. Today we're going to be discussing his book, The Complete Financial History of Berkshire Hathaway, a chronological analysis of Warren Buffett and Charlie Munger's conglomerate masterpiece. Let's ask Adam 5 good questions. But first, I'm happy to announce my literary debut, The Rebel Allocator, is now available on Amazon in both print and digital formats. You could say it's about time. I've been pouring my heart into this book for more than 3 years. A well-known SoCal billionaire received an early copy of the book and actually called me to say he enjoyed the story and was adamant that I get it made into a movie. Talk about a surreal experience getting 20 minutes on the phone with one of my heroes. My friend Tobias Carlyle had this to say: Jacob Taylor has written a modern-day investment classic. The Rebel Allocator is reminiscences of a stock operator for value investors. It's a fictionalized retelling of the lessons in The Intelligent Investor in an accessible page-turner. If you want to learn how to invest like Warren Buffett by sitting at his knee, this is the book for you. Wow, how flattering is that? I was blown away when he sent me that. I've created dozens of ad-free author interviews over the last 5 years and never asked for anything in return. If you've gotten any value out of these efforts, please do me a personal favor and pick up a copy of The Rebel Allocator. I promise you won't regret it. And now, on with the show. All right, welcome back to the show, everybody. My guest today is my friend Adam Mead, who has written perhaps one of the most comprehensive books I've ever seen on Berkshire. And there are a lot of books on Berkshire, obviously. And it's called The Complete Financial History of Berkshire Hathaway, a chronological analysis of Warren Buffett and Charlie Munger's conglomerate masterpiece. Bit of a mouthful, but Adam, welcome to the show.
Great to be here, Jake.
So, I was telling you before we started recording that, I can't imagine how much source material that you had to sort through and organize to weave together all of the numbers and the story behind really a life's work for somebody, which, with Buffett and Munger. How did you do that? Before we even get into our real questions, I'm just amazed that you were able to put so much together. How did you do that without going insane?
Yeah, no, I don't. I think if I knew how much was involved before I started, maybe I wouldn't have done it. It just it kind of proceeded logically, and just one thing led to another. And there were definitely times where I said, "Oh my gosh, did I get myself in over my head?" Because, you're right. It's the story of Berkshire Hathaway is it's a life upon itself. But then you think about all the subsidiaries that went into it, and I have a bunch of them on my bookshelf. There were entire books written on Marmon and Shaw and some of the other subsidiaries. And so to tell that story of all these other stories, it was certainly a challenge. I did kind of a rough, just back of the envelope, source material. I think I digested well over 10,000 pages of material, including the transcripts, all the 10Ks, the annuals, many of the subsidiary annual reports. And the way it's laid out, it's ultimately Berkshire Hathaway through my eyes, and I'm a very logical, step-by-step person. So going year by year, it made it less daunting. There were certainly times, Jake, when I was in the mid 70s or something writing, and I said, "Oh my gosh, I still have 40 years left to go." And well,
the problem is too is that
breaking it down,
they never divest anything.
Yeah.
So each year it adds, it's like this a whole new layer that has to be done again for that next year.
Oh, exactly. Yeah. Although it's interesting, you can see kind of behind me here on that second shelf, I have every annual report in the physical format from 86 to 2020. And I think it was 2017 in that year in the book. I did a little quip. It was like a little quip in the footnote. And I said, from, I think it was 80, I used 86, I think it was 2017. The annual report grew at a 3.3% annual growth rate. But those reports didn't grow by much. And yet, as we know, Berkshire's business expanded enormously. And so inevitably things shrunk down. And it was interesting, Jake, to see a lot of these businesses like literally fade to a footnote in Berkshire's financials. Like, Scott Fetzer doubled Berkshire's revenues in 86, literally a footnote in 2003. Shaw, I mean, it's interesting, and it kind of speaks, it almost brings up some questions about, the future, or how to look at Berkshire Hathaway today.
Yeah, I think there's something kind of magical, and I think they've talked about this before. And I think even in the most recent annual meeting, he talked about how the bigger companies that do well, they sort of grow into being more prominent and a bigger part of the puzzle. So like the things that are working make things work, and the things that are sort of fading, they just become less important. And there's sort of like a portfolio implications to that.
Oh yeah, for sure. Yeah, and he was referencing, I think, the mistakes, but there were some businesses. Again, Scott Fetzer was a great business. It just didn't have the ability to grow. But you're right, and I was even struck just during my time reading about these businesses. Yeah, you'd like to know more, but it almost, again, use Shaw for example. Or Clayton, they were public companies before, and they had all these financial statements. And if you or I were looking at it, we'd spend all day looking at the financial statements, and then you look at it in Berkshire, and there's a paragraph maybe at most. And I often would ask myself, like, is this all I like really need to know about this business? It was just kind of interesting to say, okay, like I got the gist of this whole business in a paragraph or a couple of figures. But it was fun. It was fun kind of tracking these businesses over time in Berkshire's over Berkshire's long history.
Yeah, so I think we did a good job of tackling question number one on accident. Question number two is, looking through all of these now 5 full decades of operation for the current management, which of those decades was the most impressive to you?
The most impressive. It's hard because they're all so impressive. But I'll take a step back and just kind of when I paused at the 50-year mark, Jake, and I said, and what I like and what I hope to convey with this book is the ability to zoom in on all the great details, but then kind of zoom out and see some of these trends over time. And when I stopped in 2014 and looked back over each 10-year period over Berkshire's history, it was interesting to see. We talk about the concentration in the equity portfolio over time. And that's been true, but there's also been concentration and bigger bets in dollar terms in the wholly owned businesses. So, for example, the largest acquisition in Berkshire's history as a percentage of its equity capital, I won't turn it around and ask you what it is, but if you want to venture a guess, it's
BNSF maybe.
Nope. So,
well, let me think. I'm that's recency bias.
It's hard to. I know. So BNSF was about 18% of Berkshire's equity capital at the time that it was made. The Rockford, Illinois bank in 1969 was 44% of Berkshire's equity capital when that acquisition was made. Even bigger than National Indemnity, which is about a third, or maybe about 28%. So, but what you see, I guess my bigger point is, you in each decade, the largest acquisition was about 15 to 20% of Berkshire's equity capital. So you see this sort of wash, rinse, repeat over the decades. But the decade, I guess, that I kind of gravitate to as maybe my favorite decade was the 85 to 94 decade, and I go, the origin is 65 when Buffett took over. So that's why these 10-year periods are the way they are. But it's this decade that they got out of textiles. They got really big into insurance. They kind of figured it out. They got into super cat insurance, reinsurance. And so they were small enough to make meaningful acquisitions. I mentioned Scott Fetzer, which doubled its revenues at the time in 1986. But they were they were large enough to make these bigger deals. And you see the Cap Cities ABC deal during that decade. And so it's kind of like this sweet spot of like Berkshire, like really getting ready to kind of jump jump out of the gate, figured out the formula, and you really see them take off during that decade. So it was a fun decade for me.
It seems like too, they added a lot of, they bought a lot of equity positions, marketable securities that are still on the books today. And like they were costed from that time period. And so like they have these huge unrealized gains on them. And like there was a lot of core wealth built from those that happened in that time period for me.
Oh, for sure. Yeah. I think American Express is one of them. That changed a little bit. Yeah, Coca-Cola, the 1.299 billion cost basis remains to today. The shares have only changed because they've split, but yeah, they haven't touched it, which is it's pretty cool to see. It really is neat to see, and then follow it through time.
Yeah, now he gets like a 50% dividend yield on his every year on his cost.
Yeah, I forget. I think it was. I have to go back and look. I mentioned it in the book. I think it was 2010. Buffett said, geez, in 10 years, our dividends will maybe exceed our cost basis. And that it didn't quite happen, but it's pretty darn close. But it was kind of cool. It was kind of cool to see.
Yeah. I think that's a good choice I think I'd probably pick that time period as well, because I think, well, this is a good segue actually for question number 3, which is a lot of the success came from being tied to insurance. And I even saw one study at one point that probably came out 10 years ago that said that the leverage of float, basically, that Berkshire was able to use added something like 10% to the return of equity, basically. And, I'd be curious to see what that updated, what it would look like, that study. And I'm not exactly sure how they teased all that out, but obviously insurance is a huge part of the value that's been created in Berkshire. And I thought you did a really good job of tackling the insurance part through the decades. What were some of your observations on deep diving through, one of the most successful insurance companies of all time over the decades and how it morphed?
Yeah, and to start, it really is incredible. And that study that you're referencing, it was an academic study, and it was interesting because you're right. I mean, without a doubt, the float provided this leverage, but in an academic sense, it was like, oh, well, just buy these safe companies and apply this leverage factor.
Yeah.
Like you and I can just go out and just leverage our holdings with risk-free capital. Works in theory, but to actually build it. And today we're removed from the past. We're removed from, this decade in the 70s and the 80s when they're building this. And it was interesting to me to see, I don't talk about Buffett's early life. Others have done a really good job talking about his early life, but to see Buffett's entrepreneurial spirit manifest itself in Berkshire as a whole, but also within insurance. And you see them forming all of these home state companies, and making mistakes, and some of them fail, and they merge into other home state businesses, or the home and auto business in Chicago. They try to replicate it in Miami, and it fails. There was a lot of pain, and they had a 10-year period between, I think, 82 and 92 where they lost a $500 million in underwriting. They made it up with the underwriting or the investment gains, but I mean, there was a painful period during that time where they really had to figure it out. They had inflation, of course, which is a timely thing today.
Yeah.
But they really figured it out. But I guess the things that I really came to appreciate, Jake, I think it was in 95, 96. So when they bought Geico, Buffett starts talking about float as equity. And it took me a while to really understand the way that Berkshire has structured its insurance. The float truly acts like equity. It truly acts like equity. So, and you see this in how Buffett kind of thinks about the value of Berkshire. He says, at times you can kind of tease it out. He'll say, net income plus the change in float as adding to capital as if it were just, free money, which essentially it was. And so the key there was underwriting profitability. So they figured out if we can write profitably, this float will be free, and that's that leverage that you're talking about. And then I actually modeled it out. I think it's kind of later in the book where I said, geez, if float declines at 3%, which is the rate that Buffett said it might in a maximum, and they can make a 3% underwriting profit, that capital that it generates is permanent. So float can decline, but the underwriting essentially pays for it. I mean, it took me a little while to think about it, and I modeled it out. I just kind of like noodled it for a while, but I'm like, it's just incredible what they've created. The other thing with insurance is I came to see over time, Jake, that part and parcel with the underwriting profitability is the willingness to step back when times are tough, when competition comes in.
Premiums are soft.
Down. Premiums are soft, but it's just so amazing. And that quote that Buffett has about accepting lumpy 15% returns instead of smooth 12% returns, it applies to investments. But he was talking about insurance when he brought that up, and it just dawned on me when they started doing all these reinsurance deals that in soft markets they can stop writing or pull back on the primary business and even the reinsurance, but they effectively capture that business a couple of years later when the primary insurers need to shore up their own balance sheets. And I'm just sitting there like, it's just incredible what they've done and the discipline that they have. But it was just interesting to see this. They just wait, grab it in the reinsurance deal, move on. And there are times when, especially in the reinsurance side, where you see premiums just fall off a cliff and essentially nothing happens. And as you know, I mean, it's tough to actually do that. They've built something pretty special.
Yeah, that I was surprised by that lumpy comment as well, because I think everyone does reference that to like an investment portfolio, but I think he was talking specifically about Super Cat, and there'll be a year where there's no claims and it's like literally a zero in the claims side, but then it'll show up later and like you'll be at a 300 combined ratio. So that's it gets pretty lumpy there. And I was shocked to see when you referenced that. I think it was 84 to 92 they had like 491 million in underwriting losses, but they made up for it in investment income, it was called, at like 2 billion, right? So I mean, it's such a different world than we live in now, where you can't get 2 billion on your on your portfolio to be able to subsidize the underwriting losses today. I mean, it's just like it can't be done. And it's like I'm curious to see, do you think that we ever might go back to that kind of higher rate environment where maybe you can afford to take a little bit more underwrite, like the float is actually worth quite a bit more in that world than it is today?
Yeah, maybe. Yeah, the world that you and I,
it's hard to imagine, but
capital scarcity. I think we'll get there at some point. Maybe it's 20 years from now. Who knows? But I mean, it was interesting as I kind of went along to see Buffett's thinking change and his communications to shareholders. And then he starts saying, okay, well, geez, we might have a positive cost of float, but let's compare it to the government bond.
Right.
And so just his ability, as you know, and you're sitting there in Omaha, and he says these things, and they're so brilliant and so simple, but it clearly took a lot to think about and manifest itself in actual business operations.
Yeah, that's what makes him so good and so rewatchable. So question number 4, the effects of compounding they're so small at the beginning, and you notice that they're imperceptible almost, and you see that in Berkshire's results early on in the first 10 and even 20 years. The numbers aren't, I guess maybe it's today's environment too, where like you don't get out of bed for anything less than $1 billion, right? Like all the numbers are so huge relative to the past. But what, have you noticed any patterns especially from the early days when the numbers were not as, staggering as they are today, any patterns that you might use to detect perhaps the next Berkshire, obviously recognizing that there probably will never be another Berkshire, but, early on in its formation, those early, anything from those early days that might help you to think that you might be able to find the next one.
Well, if you buy the book, the secret is on page. No.
Yeah, exactly.
Get everybody to buy the book. No, it really, and again, just going back to like the super cat insurance or the reinsurance, Buffett even just says like, all right, we try to price to 90% of, we try to pay out 90% of losses over time of premiums. So there weren't any really, I guess the big secret, and you're right. I mean, there's without a doubt an element of luck. They started, at the end of the first conglomerate boom of the 50s and 60s. So they had all of that benefit of what was tried in the past of what not to do, and all of the, shooting fish in a barrel that they had throughout the years. But so I don't know if there's any kind of like specific thing. I mean, they can really, I think reading maybe Buffett and Munger's 2014 sort of recap after 50 years was a good thing. I mean, it's just, logical. They didn't have a strategic plan. It was just, one foot in front of the other, trying to do the smart thing, focusing on the economics over accounting, I think was a big thing that I highlight that a lot over time. But yeah, the numbers, Jake, are really incredible. And for Berkshire to not pay a dividend over time and then have this rocket fuel, which was insurance, the compounding was just incredible. And at the end of each chapter, I have this summary of the capital that was generated, and you can walk through where every dollar came from over time. But when I stopped and looked at these decade periods, specifically at the end, so from 2015 to 19, 43% of every single dollar of equity that was ever generated by Berkshire Hathaway happened in 5 years. The previous decade, I think it was almost 2/3. And Buffett, I think, talked about it at one of the meetings about this compounding effect and allocating capital. It's just incredible what the capital allocation did, and they were so good at it. But I guess, how do you spot the next Berkshire? How do you spot a good company? I mean, you could see even I guess like the first reading some of the early annual reports. In the 50s, they had these issues where plant write-downs, and I don't know if it was the accounting at the time. I didn't get into that, but they would write down the plant in below the line adjustments. Buffett comes in, and like the first letter, he says, geez, we weren't required to do this, but earnings were higher than they should be. Like just this communication, this honest communication. You can see the conservative accounting with the assumptions that they make, and the reserving and the insurance side,
playing center court.
Yeah, just this consistency of strategy and communication. And I won't give you Charlie always says invert. There's a couple examples. One I'm thinking of, I won't name names, of what not to do. I mean, there's been a couple of copycats of Berkshire over the years, and one in particular that really sort of has done things not to the tune of the good high road lessons that Berkshire is known for today, and just to have such a long run is really just incredible.
I agree. So question number 5, I mean, going through 10,000 plus pages of source material, of some of the richest, probably like densest knowledge and wisdom per page that you're likely to find in this industry. How is that writing this book actually made you a better investor?
Yeah, it's a great question. And I'd say, I mean, so the 750 pages that I wrote is small in comparison to that 10,000 plus, but I'd encourage anybody who is interested to kind of take this journey, because it really is a lot. But it's almost this paradox of like how simple investing in business is, but yet how hard it is. And then to go deep into the numbers and see this grind of year to year, whether it's the insurance underwriting that we talked about, or poundage at seas, the pound sold at seas just kind of continually declining, or the problems at Buffalo News, where again today you think of it as we know it as this great business that kind of it slid, but there were times when they bought the first couple of years were really difficult before Courier Express folded, and so just kind of putting yourself in the shoes of management, I think I do a little bit more. But as you know, Jake, in the book, the framework that I kind of settled on to look at all the acquisitions over time was this basic model of capital intensity and margins on a pre-tax basis, just to look at these companies, just the basic economics at work, and doing that in the book, I guess kind of solidified for me. I think Buffett uses that as a basic model, but I've come to use it, and I've come to hang sort of everything else off of that basic model to say, okay, it's the return on capital that counts. Let's forget about leverage. Let's remember that leverage can impact that. Remember that competition, okay, that impacts margins. Or what does competition or shifts in the industry or competitive dynamics do to change the capital intensity of the business? So all of those things kind of all roll up into that sort of simple equation. But I've at least come to use it pretty much all the time, just as a basic framework to look at every business.
Yeah, I think it's really beautiful because for me, it really shows how disciplined they were when it came to cap allocation. And I mean, they sucked. I mean, the numbers of some of the early businesses like the Scott Fetzer, like Seas, I mean, the returns on equity were and capital were just obscene, right? Like, I mean, just printing money out of these things, but there's nowhere to put more money in that business without it just radically reducing the return on capital. So to have the discipline to move it out of that business and into the next more productive place, I thought was it's just a really nice way of showing how it really, like, I think how Buffett thinks about it and how he decides, okay, well, that dollar doesn't belong in Fetchheimer anymore. Like, it needs to go over here. Right. And he's just like a maniac about figuring out where's the next best place for a dollar.
Yeah. And incentivizing the managers, right? I mean,
right.
Scott Fetzer, again, it's that they recognized, and probably not without mistakes over time, that you have to sort of give ownership in a way to the managers, but incentivize them to send you the cash. So Ralph Shea at Scott Fetzer had an incentive, and he paid Berkshire. He grew earnings while paying out more than 100% of earnings because he made it more capital efficient, and he was incentivized to do that. So all of it, when you sort of look at this masterpiece that is Berkshire Hathaway, I mean, they really figured out how to maximize business potential, but also human potential. I think that human element is something important to highlight, Jake.
I remember seeing I think it might've been the 96 meeting, and they were talking about where, like, how do they sort of decide capital? And he actually said, and I've never heard him say this any other time or writing it, but he said that he charged at that time, it was like 15 to 20% for capital for if the business needed more capital to expand. So his rate of return that he was kind of baking into what that business had to do was like, they could have all the capital they wanted, but boy, was it dear, right? And they got credit, I think, similarly back when they would send money the other direction. And I don't know, do you know how he structured it for the CEOs as far as like, what's the hurdle, or like, how did they get paid based on the amount of capital they sent back?
I've spent a lot of time thinking about that, Jay, because I know the comment you're referencing, and I've heard him talk about this a number of times. And actually, I think it was the 2018 annual meeting. I asked the very last question, Station 11.
Nice.
I asked them about compensation, and so it varies by, and they were a little elusive, but
Yeah.
he gave an okay answer.
Talks
but,
about like seasonality sometimes.
yeah, so it's, how it's not one formula. It has to be based on, one specific to that business. So, not all the other noise that's going on with the sister companies or Berkshire as a whole. So specifically under their control, and based on the economics of the business. So, if Buffett plopped you or I down and sees candy, we'd think we're geniuses making up, but it's the basic business that's actually the reason for it. So figuring out how to compensate a manager for a C's versus, say, I don't know, maybe a Buffalo News as it's declining, or a more capital intensive business like, say, a flight safety. I think that's the trick. And I spent some time trying to determine, and then you look at like another capital intensive business like a Berkshire Hathaway Energy. I tried to go down and actually read the filings and the 10K, because Berkshire Hathaway Energy is actually files publicly. At the very bottom, there's all the exhibits, and there was one, I think it was 2011, but you can actually see the compensation agreement for Greg Abel back then. And I tried to just back into, okay, cost of capital, returns on capital, like, and then even Todd and Ted, that compensation arrangement where they get $1 million a year, which is small, I mean, compared to what they're managing, but the real beauty of being compensated 80% for what you do and 20% for the other guy. So they're incentivized to share, but also 10% of the differential over the S&P. And so it's a beautiful formula that scales, because when you think about it, their margin over the S&P might shrink, and probably will shrink as the capital grows, but their actual dollars of compensation will also grow, even though that margin shrinks, just by virtue of the larger absolute dollars. So I think it's a long-winded way of answering, but there's a lot of these little sort of keys there over time in Berkshire's history, and charging a fee for NetJets or Clayton Homes, to use Berkshire's credit, for example. You really see him value the dollar and communicate that to the managers through their incentive arrangements and what they charge for capital.
Yeah, I think the other part I like about that, the Todd and Ted structure, is I think it's on a 3-year rolling average.
That's right.
So it's not just like, oh, well, you had one big year, right, and you get paid a bunch. It's like, well, we're gonna have to see this over a time period before the real money comes in. I would be fascinated if someone would write the book that was able to get a hold of all of the comp structures over the years, and just see like how did his thinking evolve on it, and like what tricks did he learn, what were the permutations, like levers that he pulled depending on what kind of business it was. That would be a hell of a book to see. I don't know who's going to write that one, who can get access to it.
Oh, I would love to. I would pay a lot of money for that book. Yeah, and these little hints that he drops over time, like, geez, we made this handshake deal with Chuck Huggins at C's, and it's never changed since. So you have to say, okay, like, it's got to be a percentage. It's got to be, and again,
Right.
He talks about, well, they're incentivized to send capital back home, and it works both ways. And I think it is different across the businesses, but when he answered my question at the 2018 meeting, Charlie pipes up and says, we're not gonna give away our secrets. I think they could have answered it, in general terms without giving away the secrets. But I suspect it's probably simpler than
we would imagine. We'd make it all complicated and
right.
Unintended consequences everywhere.
Yeah.
I think that's probably right. And I mean, there's a few points where he's praised other like teams that they've purchased and the comp structures that they had before. Like a lot of them were like low base salary with a ton of upside kind of structures. So I think you can kind of back into roughly what it is, but I'd like to know what they really, really were at some point.
Yeah,
Maybe someday.
And I'm more. I mean, it makes sense for a static business, right? But how, like, say a business changes, like a Buffalo News that went from this incredible franchise business to a good business to, this terrible business that was ultimately sold last year. Like, how does that comp structure change over time if the economics of the business changes? That I would really love to know. So maybe maybe we can get their ear next year at the meeting and try to get something out of them.
Yeah. So bonus question that we always ask, and this is for a book recommendation.
Okay.
What do you have for us?
Oh, book recommendation. Well, I'll do two. So one which I give away as a gift a lot. I actually have purchased, I think now, two boxes direct from the publisher of Peter Bevlin's book, A Few Lessons for Investors and Managers. It's a nice, tight little book, high-level summary, but it really kind of wets your whistle and reminds you of these key things. I give it away to clients and friends and new people I meet sometimes all the time.
Random strangers.
I've got it right next to me here. I just read it's this book, and I don't know how you pronounce this guy's name, but it's called The Intellectual Life. This guy, A.G. Certelange. He was from France. I think he lived from like 1860 to maybe 1950. So this is an old book, but it reminds me almost entirely of Charlie Munger, and talking about just, I mean, again, for a book written in the 1940s, minimizing distractions and trying to find time to, study and better yourself, and mental models and worldly wisdom. I mean, it was all in here. And I bought a couple of copies. This may be my new book that I give away. I found it actually free on PDF, and then I bought a couple copies on Amazon. So it's a great sort of worldly wisdom, general book, non-business book, but.
Well, Adam, really great coming on the show, and everybody, if you're even kind of halfway interested in Berkshire, this is like one of those sort of must-have on reference books, because it just has such a compendium of data collection and sorting in a logical way. And maybe tell them a little bit about the website that you put together to support that.
Yeah, so all of that research material, I kind of compiled on a website. I've called it theoraclesclassroom.com. You can also get there by brkbook.com. It'll redirect you there.
There's a rebranding.
Yeah, so you can see, I have a timeline there of the acquisitions. I have folders that have Moody's reports going back to the 1930s. A lot of the subsidiary reports and filings that were out there. So I'm still, my Twitter handle is BRK_student, and it was just a sort of a by accident, but _student. I mean, I still very much view myself as a student of business and Berkshire Hathaway. So if anybody has material that I'm missing, please let me know. It's all free. You can go there. There's book recommendations too. Jake's book's there too. Pick it up.
Oh, wow. Cool.
I hope it's a resource for people studying Berkshire and business as well.
Well, Adam, pleasure having you on, and I'm quite pleased that you put in all this effort for all of us, because this is the book that I didn't want to have to ever write myself. So thank you.
You're welcome, Jake. It's great being on your show. Thanks a lot.
Before you go, do me the huge honor of picking up your copy of The Rebel Allocator, available on Amazon in both print and digital formats. It's a business person's guide to effective capital allocation, told in a coming-of-age story of a college grad who crosses paths with a wealthy Midwesterner. It's fiction for the nonfiction reader. Thanks for watching. I hope you enjoyed this interview. If you'd like to support this author and purchase their book, click here. If you'd like to become a subscriber to 5GQ, click here. And I included a couple other interviews that you might appreciate right here. Thanks, happy reading.